you can get physical gold and silver at the Comex prices, plus transaction costs. These are not paper prices that have nothing to do with physical metal. These are wholesale prices, which have everything to do with the wholesale buying and selling and movement of metal on a wholesale level. If you want to deal with 1,000-ounce silver bars, you can get that paper price for physical silver. Good morning, it's Jeffrey Christian of CPM Group. It's not quite 10 o'clock on Tuesday, May 2nd here in New York. I wanted to follow up on a couple topics that I mentioned in last Friday's video. I said I would. The one I said I wanted to come back to today, but I wanted to mention it briefly there, and that was the issue of the premia or discounts that you get when you sell your metal, and the spreads, and how to think about that in terms of what's the price you're going to get when you actually sell the metal. And the other one was something that just sort of struck a chord, apparently, which had to do with what the Comex price and the spot price really are. So let's start by talking about the gold and silver premia. And these are Eagle premia. This is from our early April Precious Metals Advisory Monthly Report for our clients. And it just shows you the premium. And the premia for Silver Eagles is very high. The premia for Maple Leaf, Silver Maple Leafs is quite a bit lower. You have a lot of supply constraints really on official coins in general. And in that environment, you have a number of investors who have been buying what we call medallions. They're not official coins minted by national mints. They are minted by private mints, and some people call them rounds. In the Middle East and South Asia, they used to call them fake coins. I think nowadays they call them medallions as well. And a lot of people are buying those because the premia are a lot lower on them, and because they're more readily available than official coins right now. And people who are selling those rounds have been telling people, no, this is really the best way to go. And, you have this big spread between the bid and the ask for official coins that you don't have for rounds. And you get a better price right now if you're reselling rounds or medallions than if you are reselling official coins because of that spread. And the point we made last Friday is that the spread today is not what matters to an investor. What matters to an investor is what the spread will be when you want to sell. Right now, the spreads for coins is very high and very large because investors are buying a lot of gold and silver, and they're driving the prices higher, and they're also driving the premia higher. And investors, generally speaking, prefer official coins to unofficial medallions for a variety of reasons. One is that when it comes time to sell your metal, and if you're an investor, you will sell. Even if you're a stacker, you will sell. Or if you're a stacker, your children will sell after you've died. When it comes time to sell, there are three scenarios in which you'll sell. The price has fallen and you've given up. You're selling at a lower price than you bought it. The price is higher and you want to take profits. Or the price hasn't changed and you're getting tired of it. Or your parents have died and you found a lot of silver and gold in their house and now you're selling it. And sorry for the morbidity. I'll get back to that. In two of those three scenarios, you will be much better off selling official coins because you'll get a better price. when the price is falling or when investor demand has fallen. That's really the key. What you find is the premia contract, and the premium that you can get on an official coin will be higher than the premium that you can get, or the discount that you get charged for a medallion or round. You also have quality issues. It is extremely rare for a coin dealer or other buyer of bullion coins to say, I'm not sure this is a legitimate maple leaf, or I'm not sure this is a legitimate eagle or Philharmonic coin from Austria or anything else. Official coins, generally speaking, are accepted for resale. When you go into a coin shop, especially if it's not the dealer from which you bought it years earlier, and you say, I have these medallions or rounds or unofficial coins, and they were minted by the XYZ mint in whatever state or country, they have every right, and a lot of times they have a good reason to say, let me have this assay before I buy it, or I'm going to charge you a really big discount because I'm not familiar with this producer of rounds or medallions or small bars. There are any number of reasons for a dealer to legitimately say, I'm not quite sure about this. So you're better off when it comes time to sell to have official coins. And that basically is true. Now, people say, I'm not an investor, I'm a stacker. Yeah, right. You're a type of investor, and there are investors who buy and sell more quickly, and there are longer-term investors. I've told the story of my Uncle Leo. My family, my mother never understood why people paid me to tell them to buy gold and silver. She said, people should not need to be told to buy and own gold and silver. My family owned gold and silver. My father used gold in his business and had a treasury license that allowed him to buy gold, and he did. And when my mother passed away, my father having predeceased her, we had a lot of gold and silver, a lot of official coins, a lot of other things. We had gold watch cases that were 1 ounce of gold each that had been made in the period prior to the legalization of gold ownership in the United States. You could buy a watch, a pocket watch, for $50, and the case was exactly 1 ounce of gold, 23 karat or 18 karat gold. So you knew exactly what you had, and it was worth $35 the case on melt. And then there was a $5 pocket watch stuck in it. So the total cost for the manufacturer was, $40 plus manufacturing cost, and then he had a markup. You could buy that watch for $50, and you knew you had $35 worth of gold. We had those. We had a lot of medallions and rounds, and we sold those for melt value and took the proceeds and bought eagles and maple leaves with them. My Uncle Leo, because he was part of the same family, and the interest and knowledge of owning gold and silver transcended my immediate family and extended to my aunts and uncles. My Uncle Leo, as did my mother and father, bought a lot of silver circulating coins, starting in the late 50s when it was clear that the Treasury, which, at the beginning of the 50s, the Treasury had about 3 billion ounces of silver it owned that it had bought under various silver purchase acts from the 1870s up until the 1950s. But in the 1950s, the silver market started changing. We had electrification, we had air conditioning, we had consumer photography, which came out of World War II, and we had very strong and vibrant silverware and silver jewelry markets. And the price of silver was rising, and the U.S. Treasury had this problem in that at $1.29 an ounce, it could be profitable to take silver circulating coins and refine them for the silver. It was illegal, but people were doing it. Also, the U.S. Treasury had silver certificates, which were paper currency issued by the U.S. Treasury that were redeemable for silver. $1, $5, $10. I think they were $20 silver certificates, and they had a redemption value of $1. So the Treasury had to keep the price below $1 until it could extricate itself from using silver in the monetary system. And this is something that developed in the 50s and was handed over to the Kennedy administration and then the Johnson administration. And there were billions of ounces that came out of the U.S. Treasury between, say, 1950 and 1979. All of this data is in our Silver Yearbook, by the way. And this is last year's Silver Yearbook. We are releasing this year's Silver Yearbook on the 16th of May. All of the data is in there on the billions of ounces of silver that were sold by the U.S. Treasury, both in circulating coins, which were immediately sucked up by collectors for the silver content value, or just outright in bullion sales that the Treasury did in the early 60s to keep the price below the melt value until they could extricate silver from the monetary system. My parents and my uncle bought a lot of circulating silver. And then they bought a lot of other silver bullion. And they basically paid below $1 an ounce for it. Late 50s, early 60s. Leo kept that silver, and then the first quarter of 1980 came. The price of silver had started to rise once the U.S. Treasury extricated itself, 1967 or so. It went up to about $5, 1973, 74, came back down to a couple dollars, and then it started rising again in the late 70s. It wasn't just the Hunt brothers buying the silver that caused the price to rise. The price of oil, copper, lead, zinc, gold, bread, everything was rising very sharply in 1979. And I think I talked about that recently, the fact that in early 1979, people thought that gold and silver were dead as investments. By late 79, gold had gone from $190 to $600 or so, and silver had gone up sharply. Silver spiked up to $50 on an intraday basis in January of 1980. It averaged about $38 in January. It averaged about $35 in February. It averaged about $32 in March of 1980. And in February of 1980, my Uncle Leo bought a house, and he paid for it with silver. He had bought the silver at less than $1 an ounce. The guy who was selling the house, who said, yes, I'll take silver as payment, was new to the silver market. He had seen the price go from $5 to $50 and come back down to the low price of $35 an ounce. And he was listening to the hucksters in the silver market who were saying, no, it's going back to 50 and then it's going to 100. So he was willing to take and sell his house at a price of $35 an ounce. And he did. He agreed to monetize his house at $35 an ounce. And my uncle said, I will pay you silver at $35 an ounce for your house. Now, back then, it took several months, I guess, a few months, for you to close on a mortgage or a sale, a house sale. And by the time the sale closed in April, silver was averaging less than $16 an ounce. It's the price you get, and it's the premium you get when you sell that you have to pay attention to, as well as the price that you pay and the premium that you pay when you're buying. And the market will be radically different when you're selling, depending on the conditions of the market. But you can assume that those premia or discounts to spot will be very important. Now, another thing that I mentioned is you have to watch out which spot price are you being quoted. Are you being quoted the spot price in London, which is a a spot price for delivery within and settlement within 2 days? Or are you being quoted the spot price on Comex, which is the price for a futures contract that is deliverable in the current month? Most people who are involved in Comex or in futures don't deal in spot, they deal in the first nearby active contract. So the price that you see for Comex prices, the price that we use, is the nearby active, and it always is a little bit higher than the spot price because it's for 1 month or 2 months or 3 months forward, usually not more than 3 months, right? So you have to be careful because what a dealer will say is, well, I'll buy this stuff or I'll sell this stuff to you at a certain premium over spot, but they may be using their own spot price as opposed to, say, a different spot price. And you'll be thinking, oh, wow, this is a really good price, or this is a really good premium, because you're thinking about it compared to a quoted spot price from Comex or from London or from someplace else, and he's using a different spot price. So you have to watch out for that sort of thing. And then the other thing, which really seems to have struck a chord with some of the viewers and investors last week, is I pointed out that when people talk about Comex being a paper price, they're wrong. Comex prices are for futures contracts that are deliverable. This is a wholesale price, which is what my topic on Friday was, wholesale prices versus retail prices, to explain the existence of the premium and to point out that the premium that you pay for a retail ounce of silver, even at 40%, is very low compared to the retail premium you're paying over wholesale for things like copper or oil, oil's 50%, or flour, wheat, which is 15,000% markup between the wholesale price on the CME wheat contract for wheat in a grain elevator someplace in the Midwest versus a 2-pound or a 5-pound or a 10-pound bag of flour on a retail level. The Comex price is not a paper price, nor is the London price. These are wholesale prices. 100 ounces of gold in Comex, 400 ounces in London, 1,000 ounces in 1,000 ounce bars in both markets, 5,000 ounce units in Comex. You can get physical gold and silver at the Comex prices, plus transaction costs. These are not paper prices that have nothing to do with physical metal. These are wholesale prices which have everything to do with the wholesale buying and selling and movement of metal on a wholesale level. If you want to deal with 1,000 ounce silver bars, you can get that paper price for physical silver. It's not a paper price, it's a wholesale price. And if you understand that, and people are telling you that these are phony baloney paper prices, you know who's trying to feed you a bill of goods. That's all I have for now. Our market outlook is, we're telling people right now to stand aside for the next 24 hours. We have a FOMC meeting today and tomorrow. There will be a FOMC, Federal Reserve Board, announcement at the end of it, probably a 25 basis point increase. That is almost a foregone conclusion, and it's almost certain that it'll happen. The question is, how will the market react to it? If you look at recent increases in interest rates, and again, understand this, the Fed began raising interest rates in March of 2022, 14 months ago. We've had 14 months of rising interest rates after more than a decade of virtually zero interest rates. In the last 14 months, we've seen several increases in the interest rate by the Federal Open Market Committee. And sometimes the market says, oh my goodness, this must mean that inflation is really rising, and therefore I'm going to buy gold. At other times they say, oh my God, the Fed doesn't know anything. Those guys without a college education on the internet know more about the economy than the Fed. The Fed's going to throw us into a recession. Everything's going to fall in prices. I better buy gold and silver. And then there are other times when people say, well, the Fed actually has thousands of really smart people that know more than the guy on the internet, and they're raising interest rates, and it's an interesting issue. Maybe they can control inflation, which has been coming down since last July, having risen for about a year or so, 15 months of rising inflation and 9 months of decelerating inflation. And sometimes the market sees the rise in the interest rates and they say, this is bad for gold. So we're telling people, just let's wait. We have Janet Yellen, who made a very important announcement yesterday. I think she's supposed to give another speech tomorrow. You have the Fed raising its interest rates. You have banking market instability. We've had 3 banks that each had specific reasons why they failed and were rescued by government programs. And there probably are other banks out there with idiosyncratic problems that could cause issues. But what we've seen is that the federal banking regulators are doing a much better job now this year than they were back in 2008. And by the way, First Republic also was a California chartered bank, and the California regulators had the first call on oversight and regulation of First Republic Bank, as they did with Silicon Valley Bank. The Fed was involved, the FDIC was involved, other federal regulators were involved, but it was a state-chartered bank. And those of you who have listened to these things, they may remember that I talked about the loose regulatory issues concerning those banks, state-chartered banks. So we're telling our clients, we do think that over the next several months, gold and silver prices probably will decline, and they probably will decline soon. They've been trading in relatively narrow ranges for several weeks now, and it's going to be important to see what the Fed says in terms of its guidance. What it has been saying, and what we think it will continue to say, is, yes, we're raising interest rates now, and we probably can pause. We might need to do another 25 basis point increase in a couple months, but we think we could pause now. But we don't think we're going to be reducing interest rates for the rest of the year. We'll only reduce interest rates when we see signs of real issues in terms of recessionary conditions emerging. So we're not sure how the market's going to react to that. We do think that prices will come down over the next several months, but we're telling our very short-term investor clients, let's wait until after the FOMC announcements tomorrow, May 3rd, and see how the markets react to them. That may, cause shorts to lose out on some of the downside, but the potential for the markets to spike higher also exists. So that's one of the issues to watch out for there. Our Silver Yearbook will be coming out on May 16th. You can go to our website and you can, I think, register to plug it into the online briefing on that day and to pre-order the book. Our Platinum Group Yearbook will come out in the middle of July. The Gold Yearbook is available already online. You can buy it. It's an ebook. You can download it. And then in a couple weeks, I guess actually next week, I better do my presentation, CPM Group will be participating in the Society of Mining Engineers 8th Annual Current Trends in Mine Financing Conference. It's a 3 or 4 day conference here in New York. Pretty intense, high-level people from the mining industry, legal, regulatory, investment banking. The Department of Energy will be there. Rohit Savant, my partner, who is the director of precious of our research operation, We'll be speaking on precious metals markets. I think I'm speaking on energy markets. You can register at this link and come. You can go to our website, learn more about us, read about us, see old videos, read old reports and speeches and presentations that we've done, and buy our yearbooks and buy other research. Until Friday, take care of yourself and those around you. Try to do something good for the world, and we'll talk to you then.